Today we're going to talk about health savings accounts or HSAs. We're going to talk about, the benefits, the pitfalls, a couple things to watch out for, and some things that these gurus online never actually talk about when it comes to HSAs. So let's get into it. I'm Derek Mazzarella with Gateway Financial Partners. Let's roll. All right. So first of all, is what is this plan? So basically, it's a tool to help you save for health expenses and medical expenses in a tax efficient way. All right, so let's get a little bit about the tax piece of it. So to the taxes. All right, so unlike every other vehicle, generally you're getting either taxed on the way in or taxed on the way out. Health savings accounts have the only triple tax savings advantage vehicle there is. Right? So the cool thing is with HSAs, you get a tax deduction when you put money in. You get tax deferral as it grows, and then when you take money out, you pay no tax. Now, there's a catch here where there's no tax. You have to use it for qualified medical expenses. If you just take the money out for buying a new car or whatever the hell you want, you're going to pay some taxes and a penalty. But if you use it for qualified medical expenses, you don't pay any taxes on the amount that you take out. All right. So what's considered a qualified medical expense? So those are gonna be things like deductibles, right? Because nowadays we have terrible health plans that we pay money into it, and then we have to pay more money when we use it. It's one of those cool features of it. But like doctor's visits, it's going to get prescriptions. Some surprising things may include like weight loss treatments, sunscreen, anything like kind of medically related. Just make sure you double check with your HSA provider to see what a qualified medical expenses, but it's going to be the routine stuff like dental care, vision care for these slick glasses that I have here. So you can use it for a variety of different things and not just to offset, out-of-pocket expenses from your medical plan. Okay. And here's the thing, when it comes to an HSA, there's a couple things that we need to be aware of when you set it up. So it needs to be paired with a high deductible health plan. Okay. Aren't all plans nowadays basically that? Yes, to an extent. But it's not just any high deductible health plan, and this is where a lot of people can get tripped up when it comes to HSAs. High deductible plan just typically means you have like a $2,000 or $3,000 individual deductible, maybe a $6,000 or $7,000 or $8,000 family deductible. But there's really two key differences with a traditional high deductible health plan and a HSA eligible high deductible health plan. So one is the way the deductible is counted. So basically, almost every high deductible health plan has copays. But high HSA plans, typically they flow through the deductible first. Then once that bucket, let's say it's filled all the way up, that's when things turn to copays. So some of the things that fall in this category that don't in a high deductible health plan is prescription drugs, right? So if you have a lot of prescription drugs, the tax savings of an HSA may actually not be worthwhile compared to what you're actually spending on drugs. So you want to really be careful with that. And the second difference is when it comes to families. So if you're an individual, you don't have to worry about this. But if you're a family plan, most family plans will have two numbers to it. So basically you have the, let's say $2,000 individual deductible, and then you have the $4,000 family. Now, with a regular high deductible health plan, only one person can spend $2,000 in the deductible. Once the deductible's hit, they satisfy that, and then the insurance company is going to cover the rest, unless you have co-insurance or other stuff. With an HSA plan, one person can actually spend all $4,000 of the family deductible by themselves. So that's a pretty big difference. So if you have one member of the family that is really unhealthy or needs a lot of health care, HSAs may not make sense for you too. So you really want to make sure you understand the policy and you understand how it works, because yes, the tax treatment of HSAs are awesome, but if you're spending so much money out of pocket that the plan doesn't make sense for you, that's definitely something you have to weigh, because this is a healthcare plan. It's not just a tax vehicle. All right, so I want to make sure that is very clear, because a lot of people get tripped up on that, and you hear all this magical stuff on the internet about how awesome they are without talking about this piece of it. And the other cool features, though, of HSAs in general is you can actually, once you have that money in your bucket here, your HSA bucket, you can actually invest that. So it doesn't just have to sit in a cash account, not waiting for you to come get it. You can invest in stocks, bonds, mutual funds, whatever your HSA provider allows for. So The other benefit is, unlike an FSA, a flexible spending account, the money could roll over year to year. So every year you can have this accumulate. So if you don't need, much care or don't really need to use it, you can have this money roll over for years and into retirement. In fact, you actually, use the care now, save the receipt, and then pay yourself later for tax-free income in retirement. So it's a pretty cool feature of it. So you don't have to worry about the use it or lose it rule with FSAs as well. One other thing to look at is the contribution limits, right? So for an individual, the limit is $4,300. This is as of 2025, so this will probably go up if you're looking at this in 2026. So hello from the future. Family cap is 8,550, and if you're over 55, right, you get a $1,000 catch up that you can add to either of these numbers here. So you get the ability to put some money away on a tax efficient basis. You could use it for your healthcare. And that's kind of really in a nutshell how HSAs work. So it's to recap, it's a triple tax savings vehicle because you're saving money on the way in. It grows tax free, and then you take it out. You pay no taxes as long as you're using it for qualified medical expenses. It does need to be paired with a health plan. Typically, it's done through your employer and through payroll. One other benefit is a lot of companies will actually match and throw money in there on top of your contribution limits here. So you can get some additional cash into this plan for you. And you can use it for retirement later on. So just make sure that the plan fits you and your needs and your healthcare needs. But it could be a great tool to use now and later in retirement for a triple tax savings opportunity. So Derek Mazzarella with Gateway Financial Partners. If you liked the video, please hit like and maybe subscribe, or we'll hang out again sometime.